Another reason to get excited is that you got 5 days left to take advantage of that coupon code link down below for the programs on Building Your Wealth. You get lifetime access to the course member live streams we do after the pre-market open live stream every day, and possibly we'll start on weekends for elite hustlers within the next week or so here, TBD on exactly when.
And, we view the stock's valuation as highly compelling at these levels.
Yes.
Remember, Tesla fell by 65% last year. It was a broad-based EV sell-off, so its decline wasn't as bad as some of its peers, such as Lucid and Rivian, both of which fell by 82%. But we feel that so much of the headwinds are priced in at these levels that it's really a compelling buy, and investors will be glad that they bought this stock at these levels, looking down the road, 1, 3, 5 years from now.
There are some headwinds, though. You acknowledge, Garrett. What are the? Can you summarize the top three headwinds? I mean, is it good for market share that you see prices discounted? Is it are supply constraints? Are those still affecting delivery so that they're not going to be what had been promised? And what about Mr. Musk's other interests, if you will?
Oh my God.
No, I think you just reeled off the major concerns there. It's really demand has been a major worry of investors. Production, Tesla's quarterly production has exceeded its sales for the last 3 quarters, so they've built some inventory. But what they've done to respond is cut prices, which they just announced a week or two ago, and also the company's lower priced Model 3 and Model Y vehicles are now eligible for a $7,500 federal EV tax credit. So we think those two things are really helping stimulate their sales. We're seeing that anecdotally in some of the sales data that we've seen recently. As far as Elon's interest in Twitter, that's still the number one headwind for the stock, just the uncertainty regarding whether he might possibly sell additional Tesla shares at some point down the road in order to continue to fund Twitter's operations.
I guess those headwinds are front and center for you, Craig?
The most important thing right now is competition, right? You can't control the demand environment, and we know competition is becoming more intense. Tesla's had to put in price cuts to defend market share. They were overly aggressive in building out capacity. So price cuts are something they will use going forward. And once they've used it, it's coming again. But the bigger thing is there's nothing they have that others don't, right? Battery technology was mentioned. The 4680 cells that are starting to cut into production now, those are based on the Maxwell Technologies dry electrode technology. The key piece there is the coaters. Some of your investors or some of your viewers would have noticed the $100 million order to Matthews Corp recently. That was, I assume, from Tesla. But if you do a little bit of work, you see that Matthews Corp sells to many different battery OEMs worldwide. So the key technology is open source. Other people in Japan and in Germany are using the same technology. Tesla does not have anything that others don't have. If their batteries were so superior, why are they buying from Chinese OEMs? It just doesn't make sense. So the posturing, just doesn't fit with the reality of intensifying competition, weak environment, price cuts necessary to drive growth consistent with capacity growth. It doesn't speak for a company that's going into a golden era. It speaks for a company that's actually done a phenomenal job creating the market, but there's probably better value elsewhere. And that's how we really encourage our clients to approach the situation.
Does that change?
Yeah, let's not mention full self-driving at all as potentially a competitive advantage. And let's not mention at all that the batteries that are being bought from companies like CATL in China are lithium iron phosphate batteries, which are generally your cheaper, lower cost batteries, and are not the structural batteries or the structural battery technology that Tesla plans to implement into cars like the Cybertruck for substantially more vehicle efficiency, power, towing capacity, range. Nope, let's not mention any of that.
They have a CFO who recently exercised stock options in late December to buy 13,500 shares. And then they also have a potential stock buyback announcement of the magnitude we think in the order of $5 to $10 billion. And so, those are the positive catalysts that we see ahead for the stock. That's what we like about it here.
Endless debate on Tesla, and it always works. Thank you, Garrett. Garrett Nelson sounds like an astronaut.
Yeah, I don't know. I mean, sometimes I feel like people have to have an opinion on Tesla. So because they have to have an opinion on Tesla, they start, spitting out nonsense. What I heard there was, I mean, I'm all for hearing negative, compelling information if it's compelling, but suggesting that Tesla doesn't have any advantage in battery technology, not mentioning the fact that as we have a commenter here mentioning Tesla's twice the margins of other competitors, the market share Tesla can swoop up with the massive free cash flow they have. I mean, again, consider it. Lucid, Rivian losing money for every single vehicle they're making. BYD has a 1.5%, 1.45% net margin. So every $100 of revenue they get, they bring $1.40 to the bottom line. Tesla's bringing $14 to the bottom line. It's insane. That's the stupidest thing I've heard. But hey, you know what? Sometimes you hear stupid things from analysts about Tesla, and some people believe it, and you know what? You just have to thank them, because you thank them for the discounted opportunity to get some more of a sweet, sweet pee-pee stock. I love pricing power stocks, and this is one that in a recession has the most pricing power out of all vehicles. That doesn't mean prices can't come down. Remember that. It's about relative pricing power. It's how much money can you make to strategically position yourself to cannibalize the competition and expand the overall pie. Pretty exciting. Do keep in mind that right now models from GM and Tesla qualify for the EV tax credit, at least through March. In March, we'll get some more curiosity in terms of how many cars will actually qualify. That is, we'll get a little bit, hopefully, more guidance from the Treasury Department, and that's because in March, probably for April and on, we'll get some more battery sourcing requirements that are implemented. So we'll see, but right now it's expected that new battery sourcing requirements to qualify for 2023 EV tax credits beyond April will require 40% of battery critical minerals and 50% of other parts to be sourced in North America or countries with a U.S. free trade agreement. Critical materials or critical minerals are basically non-fuel minerals or mineral essential to the to economic or national security to the U.S. So these are pretty important. These are going to be things probably much like lithium, nickel. These are things we do not source a lot of in the United States. If using recycled material, North American minerals must be 50% or more of the value added. If a newly extracted or processed critical mineral, then the same requirement as recycling is implemented, but with 50% of extraction steps or processing steps occurring within the U.S. or in a free trade country. So you're really requiring multiple parts of that supply chain. Remember, there's extraction, then there's refinement, then there's shipping to your destination. A lot of pieces here. My guess is that, look, for the first probably 3 months here, we're good with the 7,500 EV tax credit for Teslas. They've got a big banner on the front of their page. Until March 2023, certain Model 3s and Ys qualify for the $7,500 EV tax credit. When we get those new IRS rules and a new Treasury guidance, which we expect in March, I wouldn't be surprised that we actually see some of these requirements fall so that more vehicles qualify for the full $7,500 rather than dropping to the $3,750 that they would otherwise fall to. The reason I believe that is because right now we are led by a Democratic administration that is trying to do their best to maximize what they have been able to pass. They were able to pass the Inflation Reduction Act, which included the EV tax credits, and the CHIPS Act. They were able to pass a lot of spending provisions, and the Treasury Department is led by Democrats under the Biden administration. So I would not be surprised to see these EV guidance rules actually end up loosening come March, and more vehicles end up qualifying for those EV tax credits, specifically because of the Biden administration, what we're seeing. Do keep in mind, we also are seeing Europe implement their own EV tax credits, like a $7,000 EV tax credit coming to Germany for Teslas. This is in part because Chancellor Olaf Scholz from Germany and Emmanuel Macron from France have been kind of complaining about the U.S. Inflation Act. They believe that the $500 billion in spending and tax breaks are not fair to Europe, and that they don't comply with international rules because they unfairly entice companies to shift their investments to the United States versus Europe. They actually think they might potentially sue the United States at the World Trade Organization, complaining about what's being called the subsidy race. Basically, the government spending spiral to compete for electric vehicle and green businesses. The U.S. obviously wants to recapture its manufacturing base of American-made vehicles. This comes as Ford is cutting 3,200 jobs in Europe. Another slap in the face to Europe. So you're getting more tax credits in America, and now Ford saying they're cutting jobs in Europe. Yikes! So you've got some political nonsense going back and forth. Personally, I actually believe the best beneficiaries of this political infighting are actually EVs, electric vehicle manufacturers, because ultimately what will end up happening is not less spending for EVs, because that's not a Democratic priority, and Democrats are certainly with green priorities are obviously in the driver's seat right now in America. And green priorities are more commonly accepted in Europe. So I really believe the EVs are going to be the beneficiaries here. And do keep in mind, earlier in this video here, we talked about how much money folks are able to make as unioned employees, and that's great when you're an employee. But one of the reasons Tesla actually potentially has superior margins is because not only are they highly automated, they actually bought a German robotics manufacturer and have been using that company substantially for building their own proprietary robotics. Which is another moat, by the way. It's another moat around the competitor being able to have the margins that Tesla does. Tesla literally bought the machine manufacturer that makes the robots that make the cars. But you also have a substantially you have a completely non-unionized workforce in manufacturing. You don't have the massive pension liabilities and overhangs that you do at legacy autos like Ford and GM. Operating margins at Tesla are actually pretty similar to the margins that you see at some of the luxury automakers like Ferrari and Lamborghini. And so obviously we also expect EV sales to rise over 3.5x globally over the next 5 years, expecting to get to 17 million units produced by 2026. Obviously, Tesla will get all of those. Model 3 and Ys are pretty reliable on the EV market. Obviously, I'm kidding. They're not going to get all of that. We do know that Elon Musk's goal is to eventually manufacture as many as 20 million vehicles. And with the new announcement of the Giga expansion yesterday, there is an expectation that Tesla's going to get a big old market share, especially for the electric semis market, which really nobody else is playing in right now, which is pretty remarkable. Tesla earnings obviously coming up today. I'm relatively bullish about that, mostly because I think a lot of those price cuts we know, especially in the United States, really didn't start happening via tax credits in the last week of December for $7,500, in the month of December for $3,750, and then of course the actual price cuts not until January. So I think most of that margin impact won't be seen for Tesla, and so I think margin could actually nicely surprise, especially as we're coming out of 2 quarters of potential Shanghai pain. Although we'll see what kind of blame Tesla puts on, pressures from China, which hopefully reverse going into 2023. So we'll see when it comes to those earnings. Though the Tesla semi announcement, the Giga Nevada expansion announcement, pretty exciting. $3.6 billion investment, 3,000 additional staff, 4 million square feet of new manufacturing, a 100 gigawatt 4680 cell. That's enough batteries for 2 million light duty vehicles annually. Thanks, Sawyer, for that. New high volume semi factory. I mean, that's pretty exciting. They've got a nice render of the factory as well that's been circulating on Twitter. I'll show this. This is just a render, so it's not actually anything too spectacular, but essentially you see another gigafactory here with Tesla designed on the roof thanks to their solar panels, and then you can actually see a whole line of Tesla semis, which is interesting because I like how the rendering shows that the Tesla semis would have like basically cargo already attached to them. I don't think that semi-trucks coming off the line are going to have cargo containers already attached to them, but they definitely look better for the rendering than if they didn't, because this is what they look like without cargo attached. And then I kind of like that one semi-truck right there, kind of like magically coming through the wall. But then again, it's just a rendering. You're not supposed to look that close at renderings. Anyway, look. It's sort of a Tesla earnings preview. Let's look at their last, and I'll give you kind of a little bit of guidance, in my opinion, in terms of what to look for and what Wall Street is looking for. So let's look at their last earnings report. So we'll go to their Q3 presentation, and we can also compare that to what the earnings estimates are from the Wall Street consensus. But I promise you, the first thing that we're going to look at is going to be right here. It is going to be automotive gross margin. So I want you to remember this. And this is what I actually think is actually, in my opinion, bullish here about Tesla. And look, I always, like, if you go YOLO call options and then you lose money trying to bet on earnings, that's your problem. And if you make lots of money, do send me a thank you. Then I'll take responsibility for it. But look, I generally don't play earnings, because you have no idea how markets are going to react to the stupidest things ever. And so I don't like playing earnings. I think you're kind of just flipping a coin when you're playing earnings. I prefer to play longer-term tactical trades. But what I want you to pay attention to here is in Q2, we had what I call Shanghai, and that was really your shutdown of the Shanghai Gigafactory, which is your highest margin Gigafactory. Do keep in mind these margins do include the electric vehicle tax credits right here, so they're a little bit elevated. But look, in 2021, we were sitting at 30 to 33% gross vehicle margins. Shanghai, we were at 27.9%. We were at 27.9%. We missed the estimate of 28.4% on margins for 2020 for Q3 here, and so the hope is that maybe we could actually beat here, but with price cuts, even a meet here would be phenomenal. So let me see if I can get any kind of consensus forward here for the quarter, which I think will be quite interesting. Let's see here, consensus on quarters. So, but that margin's going to be important, especially since we are expecting, oh yeah, here we go. Okay, no, Q3, okay, there it is. No, that's Q, why is there no Q4 estimate? That's quite odd. I actually have a Q1 estimate of 25.25 provided right now, but I'm not seeing an estimate for Q4. However, if the margin is 25.5 for Q1, that's actually, the margin should be in excess of 26% expected for Q4. So I'll work on getting a little bit more of an estimate there for automotive gross margin. But as far as the actual earnings, you'll want to write these down so you can have a little bit of a prep for when that earnings report comes out. The guidance is $1.12 for adjusted EPS, GAAP EPS $1.04, revenue, which should be relatively accurate because it's a headline number and we already have guidance on how many vehicles were delivered, but then it comes down to energy in that. I do think we're going to start seeing a slowdown in battery deliveries and energy deployments probably by Q1, but we'll see if we'll get any negative insight there. Maybe we'll get some megapack deployments to offset that. Revenue of 20.7 billion expected on top line rev. Net income expected to be 3.98. So if we can get a nice 4 on that net income, I think that would be pretty exciting. Fascinating here to see. And excited to see what we end up getting with margin. But I think margin's probably going to be your biggest concern. And again, I don't actually think it's going to be as bad as folks expect because, again, most of the price cuts were in basically Q1 over here. So we'll see, but that margin's going to be a big deal. I believe the consensus is about 26.4% right now, excluding credits is what I'm able to research here. So 26.4% excluding credits. Let's go ahead and jump for a moment to one of the last pages here, which is where we can get automotive gross margin excluding credits. Let's see here. Which page was it on? Should be on one of these back pages here. Automotive margin, we'll find it. This is the statement of cash flows. This is our balance sheet. One thing we're going to look for on the statement of cash flows, obviously, is the level of free cash flow that we had. Look at this, folks. Cash provided by operating activities, $5.1 billion. You had $3.3 billion of free cash flow at Tesla. Really, really incredible. Extremely low debt. I don't even really consider leases debt, but other long-term liabilities sitting at $4.3 billion. That's right here. Okay, well, decided to page away. But anyway, $4.3 billion, relatively low over here for Tesla. So we'll see if there was any kind of pay down for that sort of other long-term debt. What do we have? Let's see here. We've got... we'll go ahead and look at energy generation. We'll see that was a nice boost in the last quarter, coming in at about 1.1 bill. We'll see what kind of movement we have there. Again, I am expecting longer term weakness in that segment. And then automotive gross margin we know was 27.9, but that includes credits. I think I'm just going to go ahead and calculate it myself really quick what it was without credits last time, because that's easy to do. So let's just go ahead and take automotive gross profit of 5212. Let's go ahead and subtract 286 from that. That brings us down to 4926. We're going to divide that into revenues. So divided by 18,692, that brings us to about 26.35% without vehicle credits. So again, 26.35% without vehicle credits was the last one. And the Wall Street consensus right now is looking for about 26.5 without vehicle credits going into the fourth quarter. Personally, I'm optimistic on that. Again, I wouldn't YOLO bet on it, but I'm optimistic. That's clearly something we're going to be looking at. Another thing, of course, I love looking at is how much are they taking to the bottom line, right? And in this last quarter, we took 3.292 billion to the bottom line, 3.2 basically 3.3 to the bottom line. If we divide that by revenue of 18,692, that actually gives you a quarterly net income margin of 17.6%. The 14% I usually refer to as an annual figure. 17.6%, pretty impressive. So it's going to be a big day. Going to be a big day for Tesla. So fingers crossed we get some great news here for Tesla. But I'm excited, and I think there is reason to be excited. Anyway.